Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at RCAT Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's unpack this, because the defense sector right now is it's undergoing a transformation on a scale we really haven't witnessed in decades.
Yeah, not since the Cold War, honestly.
Right. If you look back historically, defense spending was defined by these massive, slow-moving legacy platforms. We're talking about fighter jets and aircraft carriers that take 20 years to design and billions of dollars to build.
And constant cost overruns.
Exactly. But today we are entering an entirely new age. It's an age defined by agility, autonomy, and most importantly, scale. So for anyone looking at wealth-building opportunities, this shift is creating immense tectonic movements in the market. Today's analysis focuses on RCAT Holdings, and it serves as a truly fascinating David versus Goliath case study in how sweeping geopolitical shifts and sudden regulatory changes can directly impact a company's bottom line.
It really is a paradigm shift. I mean, the core mission of today's conversation is unpacking how this specific defense technology company is rapidly scaling its hardware and its software, too, for what the military calls multi-domain operations.
Multi-domain, so air, land, and sea.
Yes, synchronizing efforts across the air, land, and sea simultaneously. When you look at how modern military strategy is evolving in real time, understanding the companies that are actually building the tools for this new reality is, well, it's essential for your portfolio.
Right.
So we are going to look closely at their competitive moats, their financial trajectory, and the specific market catalyst driving their current valuation.
I want to jump right into the hardware first because we need to visualize what we are actually talking about here. RCAT Holdings isn't just dealing in abstract software concepts or blueprints. They have tangible, deployed platforms.
Very tangible.
Specifically, we're looking at the Black Widow and the FANG systems. And what stands out immediately is their deep involvement with the United States Army's short-range reconnaissance contracts, which you'll often hear referred to as SRR.
The SRR program is massive.
It is a staggering demand profile. The military isn't asking for a few dozen or even a few hundred of these units for specialized test squads. The projected demand is in the millions.
Millions of units.
Picture this. You have these highly tactical, incredibly capable drones designed to be carried in the backpack of an infantry soldier on the modern battlefield, just ready to deploy in seconds.
Exactly. It becomes standard issue gear, much like a rifle or a radio. But to really understand why that specific hardware is positioned so strongly right now, you have to look at the regulatory landscape.
Because that's the moat, right?
That is where the ultimate competitive moat lies for RCAT. It is the whole reason they have the upper hand.
Yeah.
The defining factor here starts with their Blue UAS certification. Now, you hear Blue UAS thrown around a lot in defense tech, but what does it actually mean?
Right. What's the actual weight of that?
It's essentially the Pentagon's exclusive VIP list for drones. It means the Department of Defense has rigorously vetted the hardware and the software, proving it is highly secure and, crucially, that it isn't quietly transmitting sensitive battlefield data back to a foreign server somewhere.
Right, which has historically been a massive security vulnerability.
Huge vulnerability.
But the real aha moment for investors here, the thing that changes the entire game, is the fiscal year 2025 National Defense Authorization Act. Specifically, Section 1709 of the NDAA.
Yes, Section 1709.
This isn't just some minor bureaucratic policy update. This section legally bans foreign drone components from United States defense procurement entirely. So how exactly does a law like that translate into a financial advantage for a domestic company?
Think about it like this. Imagine you are running a marathon. You've been training hard, but you're constantly getting beaten by a specific group of runners who have access to cheaper, highly subsidized training gear. Then right before the starting gun fires, the judges step in and legally disqualify the 10 fastest runners who usually beat you, simply because their gear violates the new rules.
What, so they're just out of the race?
Completely out. Suddenly, you aren't just competing for first place. You get to dictate the pace of the entire race. That is what happened here. By eliminating non-U.S. competition manufacturers who have historically dominated the market and relentlessly undercut domestic producers on price way, The government has essentially handed a massive pricing power advantage to certified domestic companies.
That is a phenomenal analogy. So
Right.
they are no longer forced into this race to the bottom on price just to win a contract.
Precisely. For RedCat, possessing that blue UAS certification and having entirely U.S.-made hardware and software means they now operate in a heavily protected market.
Right.
This regulatory moat allows for significant margin expansion. They have a massive margin edge in intelligence, surveillance, reconnaissance, public safety, and precision strike markets simply because their biggest foreign competitors are legally barred from even entering the room to bid.
That is a massive structural advantage.
Yeah.
And you can see that advantage directly reflecting in their financial trajectory. The revenue projections here are simply incredible.
They really are.
Let's look at the numbers. We are looking at an estimated $60 million in 2025, and then a projected leap to $125 million in 2026.
More than doubling.
Yeah, for anyone analyzing growth stocks, a projected doubling of revenue at that kind of scale in a single year is the kind of metric that demands your immediate attention. But forecasting is easy and executing is hard. What is actually fueling that massive leap, and why should we trust that projection?
So what here is absolutely crucial for your investment strategy. This isn't just a temporary bump in sales or a lucky one-off contract win. That revenue jump represents a structural long-term shift fueled heavily by the Pentagon's drone dominance program.
Drone dominance.
Yes. When the Department of Defense officially commits to a doctrine that relies heavily on unmanned systems, the capital flows inevitably follow. That jump to $125 million reflects the transition from small testing and pilot programs into formalized, multi-year scaled contracts.
So the test phase is over.
Exactly. It's the direct monetization of that regulatory moat we just discussed. They are moving from proving the technology works to actually outfitting the armed forces at scale.
Which brings us to a really interesting point about how they are managing all of this newly flowing capital. If you look at their balance sheet right now, it is incredibly strong. But here is the catch. They aren't using that cash for dividend payouts or stock buyback.
Oh, they are not.
Now, for a traditional value investor, hoarding cash or failing to return it to shareholders usually sets off alarm bells. Why are growth investors actually cheering that on in this specific context?
Yeah. Well, if we connect this to the bigger picture of the corporate life cycle, returning capital to shareholders via dividends or buybacks is typically what mature older companies do when they have simply run out of high-return internal investment opportunities.
Right, like a utility company.
Exactly. If you're a legacy telecom company, you pay a dividend because you aren't building a revolutionary new network tomorrow. RedCat Holdings, however, is in an aggressive, hyper-growth expansion phase. They are directing their free cash flow exactly where a growth investor wants to see it.
Into factories.
Into building physical new factories to aggressively increase their production scale, and into securing highly targeted technology acquisitions.
So we would actually be a red flag if they were paying a dividend right now.
It absolutely would be. If they were paying out dividends right now, it would signal to the market that leadership doesn't believe they have better, higher-yielding ways to deploy that cash to capture market share.
And the market share is massive right now.
Right now, the market share is theirs for the take thanks to the NDAA ban. They are reinvesting every dollar to capture as much of this emerging multi-domain market as humanly possible before any domestic rivals can catch up.
And they are certainly capturing share beyond just the sky, which is where my enthusiasm really spikes on this one. It's not just aerial drones anymore.
It's multi-domain.
Right. RedCat is actively pushing into what you mentioned earlier, multi-domain expansion.
Yeah.
We are seeing them develop unmanned surface vessels, or USVs, for maritime operations. They are effectively taking their deep expertise in autonomous aerial systems and applying it directly to the water.
And what's truly fascinating here is how they are tying these different domains together. This isn't just about selling a flying drone to the Air Force and a floating drone to the Navy as separate products. They are developing what is known as the Warfare Electronic Bridge.
Okay.
Furthermore, through their RedCat Futures initiative, they have established a highly strategic partnership with a company called Apium to integrate swarm robotics into this bridge.
Okay. A warfare electronic bridge paired with swarm robotics. That sounds like something straight out of a science fiction movie. Paint a picture for us. What does that actually look like in practice?
Imagine a coastline scenario. You have a swarm of Black Widow aerial drones flying high above. They're mapping the terrain and identifying potential targets or threats.
Right.
Instead of just sending that video feedback to a human operator who then has to call a ship, Those aerial drones are talking instantaneously, autonomously, to a swarm of unmanned surface vessels in the water below.
Seamless communication.
Exactly. They are sharing targeting data, coordinating movements, and adapting to the battlefield in real time without human bottlenecking. The investment implication of this is profound.
Because it changes what they're actually selling.
Spot on. By connecting aerial assets with maritime USVs through a unified proprietary swarm technology, RedCat is moving from being a simple hardware provider to an integrated ecosystem provider.
Like Apple.
Think about the Apple ecosystem exactly.
Yeah.
Once you have the phone, the watch, and the laptop, and they all sync perfectly, it's incredibly annoying to switch to a competitor. It's the same concept here, but for global defense.
The switching costs.
When defense departments integrate these seamlessly connected systems into their core operations, the switching costs become impossibly high. You don't just swap out a single broken drone for a competitor's model. You would have to rip out and replace the entire synchronized swarm infrastructure.
That is sticky.
Highly sticky recurring revenue. As these defense orders mature, the software and integration aspects become a massive driver of sustained wealth creation far beyond the initial hardware sale.
That ecosystem approach makes a ton of sense, and it's a brilliant way to lock in long-term government contracts.
Okay.
The tech sounds incredible, and the moat is literally protected by federal law. But the big question for anyone listening is, has the broader market already noticed?
Always the question.
How much of this is already priced in? Let's dive into the technical analysis and the recent price action, because the numbers here are aggressive. RedCat stock has surged over 60% year-to-date in 2026 alone.
60% is no joke.
No, it's not. If we zoom out slightly to look at the last 90 days, it has posted a massive 67.14% gain. And just recently, as of late February, we saw a 12.4% weekly gain.
Huge momentum.
That momentum brought the trading levels to around $12.78 at its peak before settling near $11.65 in a recent healthy pullback.
To put that aggressive price action into proper valuation context, we have to look at where the analyst community is currently placing the fair value, despite the stock trading near that $11.65 mark, which, as you noted, is a slight expected pullback from its recent peaks after a massive run analysts broadly maintain a fair value target of $18.
$18.
If you run the math on that, it implies the stock is roughly 35.3% undervalued at current levels. From a purely technical perspective, holding strong above key support levels after a 60% year-to-date run, while still remaining deeply undervalued relative to their fundamental revenue projections, signals heavy breakout potential.
Oh, plenty of room to run.
The market is currently taking a breath, digesting the initial gains, but the ceiling appears significantly higher as these multi-million unit contracts officially formalize.
The sentiment surrounding all this is a fascinating study in market psychology, too. Overall, the mood is what you'd call mixed to bullish.
Right.
On the bullish side, the catalysts are loud, visible, and undeniable. You have the successful USV maritime demonstrations proving the tech works on the water. You have the immense momentum from the Pentagon drone dominance contract. And they even rang the NASDAQ bell on February 20th.
The bell ringing is great for optics.
It is, which, while ceremonial, brings a huge amount of institutional and retail visibility to the stock.
That visibility is a double-edged sword, though, and as investors, we have to address the bearish-leaning noise objectively. You will absolutely see intraday volatility with this stock.
Definitely.
But if you look closely, a lot of that volatility is tied to broader sector weakness rather than any company-specific failures by RedCat. For instance, we have seen sudden pullbacks triggered by peer dilution fears.
Peer dilution.
Yes. When a competitor in the broader defense tech space, let's take Kratos as an example, faces market concerns about potential share dilution to fund their own operations, that fear temporarily bleeds over into RedCat.
Investors get spooked.
They get spooked. They think, well, if Kratos needs to issue millions of new shares to afford scaling up, maybe RedCat will suddenly dilute their shareholders too.
Right, it's the classic guilt by association. The whole neighborhood's property value drops because one house needs a new roof.
Precisely. But you have to weigh that peer-induced emotional noise against the actual structural capital flows. Right now, we are seeing heavy retail and institutional interest actively rotating into defense equities.
Capital rotation is key.
This rotation is frequently driven by broader global tensions acting as massive market catalysts, such as the ongoing geopolitical events involving Iran, for example.
Right, macro tensions.
When macroeconomic tensions rise globally, institutional capital instinctively seeks the safety and security of reliable U.S. defense contracts. Because RedCat is shielded by that ironclad NDAA ban on foreign competitors, it becomes a prime, obvious target for that massive capital rotation. The positive structural drivers heavily outweigh the temporary sector-wide emotional pullbacks.
So if you're plotting this out on your calendar and looking for where the rubber meets the road, let's look ahead to the next 3 months. What are the upcoming milestones you need to be watching?
There are a few big ones.
First, you need to circle March 18th, 2026. That is when they officially release their Q4 2025 earnings results and host their accompanying webinar.
That will be a major catalyst.
Consensus is already fiercely eyeing that revenue ramp toward the $60 million mark for the fiscal year. There is extremely high anticipation for potential earnings beats, driven specifically by the early SRR contracts and those NDAA legislative tailwinds finally showing up on the balance sheet.
People want to see the proof.
We also have the vital follow-ups from their February 28th Innovation Day, which provided the market with deep, granular insights into their upcoming product roadmap.
Those are undoubtedly the bullish milestones to watch. But responsible wealth building requires taking a calm, highly critical look at the risks involved. We can't just look at the upside. Let's examine the bear case.
Okay, let's do it.
The primary concern here, above all else, is execution risk. Scaling physical manufacturing is notoriously difficult. Building one perfect drone in a lab is easy. Building 1 million perfect drones on an assembly line is a nightmare.
It's a completely different skill set.
Completely different. The company is dealing with ongoing operational losses while it spends heavily to expand. They are literally building new factories to meet this projected demand. The danger is clear. If these pilot programs, like those highly publicized USV demos, fail to convert into formalized multi-year signed contracts, the company is left holding the bag.
No.
You end up with underutilized, incredibly expensive factories eating into your balance sheet every single day.
That makes perfect sense. Building hardware is a notoriously unforgiving business. But what about the broader macro environment? Let's play devil's advocate here. What if there is an unexpected political shift in Washington and U.S. defense spending suddenly gets aggressively cut?
Okay.
Or what about the competition? Even with the foreign ban wiping out the overseas giants, they still face ambitious domestic competitors like Dragonfly or the massive buzz surrounding companies like Swarmer advancing their own autonomous tech. Surely they aren't the only ones trying to build a drone swarm.
They aren't, and those are highly valid concerns. This raises an important question about what is already priced into the stock at these levels. Those risks, potential budget cuts, fierce domestic competition, the immense hurdles of execution and manufacturing are very real.
But the market reaction tells a story.
Exactly. When a stock gains over 60% year-to-date, it tells you that the broader market has already factored in a lot of those positive NDAA tailwinds, but it also means the market believes the moat is strong enough to withstand domestic challengers.
And the budget cuts.
Regarding the budget, the overall defense budget would have to see catastrophic, historically unprecedented cuts to impact the already committed, highly prioritized SRR procurement lines.
It's too important.
The military has made it clear. Autonomous drones are the future of their tactical doctrine. They aren't going to cut the very program that modernizes their infantry.
And as for the domestic competition like Dragonfly,
As for domestic competition, this is where RedCat's strategic tie-ups become their armor. The APM partnership for Swarm Tech keeps them highly competitive on the software side, ensuring they aren't just selling a flying camera, but a connected ecosystem.
back to the ecosystem.
Always back to the ecosystem. Because that structural moat is so strong and the switching costs for the military are so high, the pullbacks tied to broader market noise, like dropping from nearly $13 down to that $11.65 range, often represent a potentially compelling entry point rather than any sort of fundamental breakdown in the company's thesis.
Okay, we have covered a massive amount of ground today, from sweeping geopolitical legislation down to the intricacies of autonomous maritime swarms. Let's bring all these threads together into a cohesive strategy for you.
To summarize the overarching narrative we've discussed today, RedCat Holdings currently holds a bullish score of 8 out of 10 based on current market dynamics and our analysis.
8 out of 10.
The fundamental thesis driving that score is that their regulatory moat, firmly established by the FY25 NDAA ban on all foreign drone components, combined with massive multi-year Pentagon contracts, is setting the concrete stage for their revenue to scale massively to $125 million by 2026.
The numbers don't lie.
The play here, from a strategic analytical standpoint, is a potential swing trade heading into those highly anticipated March 18th earnings, coupled with a multi-year hold.
Swing trade and hold.
The goal of that multi-year hold is to capture the full financial scale of these multi-domain contracts as they mature from pilot programs into standard military doctrine, which fundamentally supports that $18 fair value target analysts have set.
That paints a very clear, comprehensive picture of the wealth-building mechanics at play here. It is rare to see regulatory shifts align so perfectly with a company's product roadmap.
Very rare.
But I want to leave you with a final lingering question to ponder as you look at this sector and evaluate this specific company for your own portfolio. If a company successfully scales a true warfare electronic bridge, a system seamlessly connecting autonomous intelligent drone swarms across the sky, the land and the sea using solely domestic components locked securely behind a federal ban, are investors simply looking at a hardware manufacturer making drones? Or are they actually looking at the foundational, indispensable operating system of future global security? That is the big question. Thank you for joining our conversation on wealth building today. We appreciate you taking the time to analyze the markets with us, and we look forward to exploring the next big catalyst with you soon. Have a great day.